Heterodox Views of Money and Modern Monetary Theory, MMT, by Phil Armstrong. Operational Reality and the Socio-political Layer. To understand the development of the current socio-political layer, we might first consider an earlier time when a different core reality existed, creating its own socio-political layer. The legacy left by this layer remains much in evidence today. Its original purpose was beneficial, to mitigate the effects of an earlier operational reality on society. However, it has outlived its usefulness and, in a modern context, far from being of benefit, it acts to the detriment of society, preventing the government from fully exploiting their power as monopoly issuer of the currency to pursue public purpose. It is to an analysis of this earlier core reality that we now turn. The development and eventual hegemony of this earlier monetary reality was intimately linked to a much wider change in society and the relationship between economics and society itself. Specifically, the introduction of the self-regulating market and what it required, in particular in relation to the actual operation of the monetary system. For the following analysis, I will rely heavily upon the work of Karl Polanyi, especially his seminal text of 1944, The Great Transformation. Polanyi denies the universal nature of markets. He charts the growth of the importance of markets and considers the hegemony of the market system to be a recent phenomenon. For Polanyi, man's supposed innate desire to truck and barter is much exaggerated. Early societies were not based on market forces, but on reciprocity and redistribution. Markets, up until comparatively recently, have always been embedded in society. Their influence had been controlled to protect the structure of society. The disembedding of markets, where society is ordered so as to serve the self-regulating market, is considered by Polanyi as essentially a 19th century experiment. One that, if continued without hindrance, would destroy the nature of society itself. It involved the marketization of land, labor, and money. It required reducing their essential nature to that of commodities. However, they can only be fictitious commodities. The crucial point is this: labor, land, and money are essential elements of industry. They must also be organized in markets. In fact, these markets form an absolutely vital part of the economic system. But labor, land, and money are obviously not commodities. The postulate that anything that is bought and sold must have been produced for sale is emphatically untrue in regard to them. In other words, according to the empirical definition of a commodity, they are not commodities. Labor is only another name for a human activity which goes with life itself, which in turn is not produced for sale, but for entirely different reasons. Nor can that activity be detached from the rest of life, be stored or mobilized. Land is another name for nature, which is not produced by man. Actual money, finally, is merely a token of purchasing power which, as a rule, is not produced at all, but comes into being through the mechanism of banking or state finance. None of them is produced for sale. The commodity description of labor, land, and money is entirely fictitious. Polanyi introduced the idea of the double movement, the attempt to treat land, labor, and money as commodities, in order to create a unified market society, was a utopian project which was bound to create, in turn, a counter-movement required to prevent the destruction of society. For Polanyi, there was nothing natural about a market economy. It had to be planned from the outset. The road to the free market was open and kept open by an enormous increase in continuous, centrally organized and controlled interventionism. to make Adam Smith's simple and natural liberty comparable with the needs of human society was a most complicated affair. Although the development of a market society was planned, the responses to its introduction were spontaneous, essentially defensive and necessary as a means to protect the structure of society from the action of self-regulating market. While laissez-faire economy was the product of deliberate state action, subsequent restrictions on laissez-faire started in a spontaneous way. Laissez-faire was planned, planning was not. The legislative spirit of the counter-movement against a self-regulating market, as it developed in the half-century after 1860, turned out to be spontaneous, undirected by opinion, and actuated by a purely pragmatic spirit. The critical element in the market for money was the introduction of the gold standard. This introduction forced governments to subjugate the use of their budget to the requirement to maintain the value of the currency in terms of gold. Finance this was one of its channels of influence acted as a powerful moderator in the councils and policies of a number of smaller sovereign states. Loans and the renewal of loans hinged upon credit, and credit upon good behavior. Since under constitutional government, unconstitutional ones were severely frowned upon, behavior was reflected in the budget, and the external value of the currency cannot be detached from the appreciation of the budget. Debtor governments were well advised to watch their exchanges carefully and to avoid policies which might reflect upon the soundness of the budgetary position. This useful maxim became a cogent rule of conduct once a country had adopted the gold standard, which limited permissible fluctuations to a minimum. Under the gold standard, the operational reality was different to the reality facing a government issuing its own fiat currency under floating exchange rates. When the gold standard operates, the government effectively becomes a currency user. When the government buys anything other than gold, they have to have, so to speak, money in the bank to pay for it. The government, like everyone else, is prohibited from simply printing money to pay for the things it buys. Everything else, other than gold, on which the government spends is covered by taxes or borrowing. Therefore, expenditures by the government from its account at the Fed are continuously offset by receipts of taxes or borrowed funds. The international mechanism which allowed the gold standard to function was constructed over an extended period around the revolutionary utopian idea of a self-regulating market. In principle, when nations joined an international economic community using a gold standard, trade imbalances would be removed by gold movements, provided the system was allowed to work unhindered. A nation in deficit would pay in gold, requiring, in principle, a reduction in its money supply. The consequent deflation and contraction would restore competitiveness, raise exports, and move its external account towards equilibrium. In contrast, the surplus country would receive the gold, allowing the monetary expansion. The consequent inflation and expansion would reduce competitiveness, and, in turn, the trade surplus would fall. In practice, such a process would be slow and painful, and central banking could provide a defense. The central bank could mitigate its effects by raising the bank rate to stem the gold flow. Raising the interest rate would make holding a nation's currency or its government's bonds more attractive than previously in comparison to conversion into gold. The go-to policy of nations facing a gold drain was to raise the bank rate. A higher interest rate should spread the adjustment burden by reducing the demand for bank credit, slowing growth of income, and thus reducing the inflow of imports. This would be a far less painful form of adjustment than the deflation following from an outflow of gold. Such a policy, though, would represent a corruption of the self-regulating market for money, as interest rates, in principle, should be left to the market and be determined by the balancing point between the supply and demand for loanable funds in domestic currency. Central banking can be viewed as an intrinsic part of a necessary countermovement in Polanyian sense. It was an essential introduction under a gold standard. Without it, deflationary adjustment would be too painful. Central banks, however, would need to adjust their interest rates to the situation vis-a-vis protection of gold reserves. To this extent, interest rates were market determined. The central bank could not set interest rates at a level suitable to optimize domestic performance. Its priority was maintain the nation's integrity as a member of the gold standard club. Under 19th century conditions, foreign trade and the gold standard had undisputed priority over the needs of domestic business. The working of the gold standard required the lowering of domestic prices whenever the exchange was threatened by depreciation. Since deflation happens through credit restrictions, it follows the working of commodity money interfered with the working of the credit system. This was a standing danger to business, yet to discard token money altogether and restrict currency to commodity money was out of the question, since such a remedy would have been worse than the disease. Central banking mitigated this defect of credit money greatly by centralizing the supply of credit in a country. It was possible to avoid the wholesale dislocation of business and employment involved in deflation in such a way as to absorb the shock and spread its burden over the whole country. So we can see that in the days of the gold standard and fixed exchange rate regimes, the government's budgetary policy was constrained by external forces. Effectively, it had to act like a currency user, and its central bank's interest rate policy was not free to be used to pursue public purpose. The use of interest rates became part of the socio-political layer and had to be tailored to the needs of the self-regulating market. If the trading class was the protagonist of market economy, the banker was the born leader of that class. Employment and earnings depended upon the profitability of business, but the profitability of business depended on stable exchanges and sound credit conditions, both of which were under the care of the banker. It was part of his creed that the two were inseparable. A sound budget and stable internal credit conditions presupposed stable foreign exchanges. Also, exchanges could not be stable unless domestic credit was safe and the financial household of the state was in equilibrium. In the 1920s, the gold standard was still regarded as the precondition of a return to stability and prosperity, and consequently no demand raised by its professional guardians, the bankers, was deemed too burdensome if only a promise to secure stable exchanges. All Western countries followed the same trend, irrespective of national mentality or history. With the international gold standard, the most ambitious market scheme of all was put into effect, implying absolute independence of markets from national authorities. World trade now meant organizing life on the planet under a self-regulating market, comprising labor, land, and money, with the gold standard as the guardian of this gargantuan automaton. Nations and peoples were mere puppets in a show utterly beyond their control. They shielded themselves from unemployment and instability with the help of central banks and customs tariffs, supplemented by migration laws. These devices were designed to counteract the destructive effects of free trade plus fixed currencies, and to the degree in which they achieved this purpose, they interfered with the play of those mechanisms. The old operational reality has now gone, at least for countries which are now part of the euro or operating under fixed exchange rates. The nature of the relationship between the core monetary reality and the socio-political layer has drastically changed from the situation which prevailed under the gold standard and the Bretton Woods system of fixed exchange rates. Sound money, government, budgeting, and market-led interest rates might have been seen as necessary and beneficial under the gold standard, but now they are out of date and hamper progress. However, in general, Neoliberal politicians and neoclassical economists have a deep yearning for the old operational reality. So much so, they retain the old socio-political coding that is now out of date. However, from their point of view, it is essential, a vital restraining influence upon democracy and the ability of the state to use its position as issuer of a non-convertible currency under floating exchange rates to pursue public purpose. I am not, of course, suggesting they understand the situation in this way. We might consider two market-oriented perspectives. Both advocates of the gold standard and monetarists, new classical economists, favor the subjugation of government policy to the impersonal forces of the market, but approach the issue from different perspectives. Both groups favor fixing one thing and letting the market do the rest. For the gold bugs, the exchange rate should be fixed, setting up a core monetary reality which requires government monetary and fiscal policy to be constrained by the needs of the market. These manifest themselves in the political system, where budgets and interest rate policy must satisfy the requirements of the international market for money. Monetarists take a different approach. They believe that monetary growth should be fixed and market forces should be left to deal with everything else, including the exchange rate. Friedman is critical of the working of the gold standard in practice. In his famous interview on the gold standard, he points out how the theoretical mechanism which is built into the gold standard fails to deliver the goods, citing the Great Depression as an example. However, he is careful to specify human error as the real culprit. He contends that the Federal Reserve had sufficient gold reserves to expand the money supply and prevent an economic catastrophe. According his perception, they failed to do so, and so the crisis continued. For monetarists, the preferred way to subjugate democratic government to markets is for the central bank to use its supposed ability to determine the rate of growth of the money supply to guarantee price stability. However, such an approach naturally ties the hands of government and central banks alike with respect to the use of discretionary policy. If the central bank fixes the supply of money, then demand for money must determine the interest rate. Thus, interest rates would be beyond the control of the authorities and in the hands of markets. Governments would be constrained in their use of fiscal policy, unable to use deficit spending to expand the economy. If the deficit was financed by printing money or selling debt directly to the central bank, this would break the money growth rule and thus be inadmissible. If it was financed by the sale of debt to the private sector, this would raise interest rates and crowd out private sector investment. Both approaches were based on faith in markets and were utopian. Neither was practical in reality. As we have already stated, the introduction of the gold standard generated spontaneous responses which were essential if society was not to be annihilated. Its mechanism had to be impaired in order to protect society. In the same way, it is impossible for a central bank to control the rate of growth of the money supply in practice. The so-called Volcker Experiment provides supporting evidence for this assertion. In 1979, when Paul Volcker was chairman of the Fed, the intermediate target of choice was changed to the rate of growth of M1. Implicit in this approach was the need to allow the Fed funds target to rise as high as necessary to allow achievement of this goal. The Fed would calculate the total reserves consistent with its monetary target, then subtract existing borrowed reserves to obtain a non-borrowed reserve operating target. If the Fed did not provide sufficient reserves in open market operations, as it hit its non-borrowed reserve target, banks would simply turn to the discount window, causing borrowed reserves to rise, and, in turn, the Fed to miss its total reserve target. Because required reserves are always calculated with a lag, Ray gives full details, the Fed could not fail to provide the needed reserves at the discount window. The Fed found it could not control reserves. Conventional thinking is based on the idea that banks need excess reserves before making loans, and a deposit multiplier exists. However, in practice, banks make loans without reference to prior reserve positions. Faced with a customer deemed creditworthy, a bank makes the loan and obtains the reserves later. Thus, the quantity of reserves is determined by the amount of loans issued, not the other way around. In this case, the role of the Fed is passive. If banks in the aggregate are short of required reserves, the central bank must supply them, either through open market purchases or the discount window. Trying to restrict reserves through fewer open market purchases merely forces banks to the window. It is simply impossible for the Fed to refuse to supply the reserves needed by the system. We can see that monetarism, in its pure form, is simply another utopian project, which cannot work in practice. A policy following the monetarist blueprint would require wild swings in interest rates at best, and the breakdown of the interbank payment system at worst. Clearly, such a situation would be politically unacceptable. This was reflected in the socio-political layer in the time of the monetarist heyday. I well remember Friedman's response to the introduction of the so-called medium-term financial strategy, MTFS, in the UK. He was very supportive of the idea of the introduction of monetary targets, but scathing about the use of interest rates as the means to achieve them, preferring, of course, the use of reserves, in his view, the raw material of money, as targets. The utopian nature of monetarism was apparent. True monetarism would mean the imposition of too heavy a cost on society, so a nominally monetarist approach was adopted, which allowed the government in the UK to draw on the free market dogma and inflation prioritizing of monetarism while keeping interest rates under their control for political purposes. In a sense, the Thatcher government attempted to have their cake and eat it. Interestingly, central banks, while accepting the practical problems associated with basing policy on mainstream economics, whether that be monetarism, an updated version of monetarism, or the current go-to theory of choice for most central banks, New Keynesianism, have all maintained its theoretical credibility. Clearly, accepting short-term money neutrality and using pure monetarism would be a practical disaster, but rejection of mainstream theory is also off the menu. New Keynesianism is very useful as it accepts the short-term non-neutrality of money, legitimizing a central bank's use of the short-term interest rate to influence not only inflation but also real variables. Crucially, though, New Keynesianism retains the view that money is neutral in the long run and therefore merely determines the price level. Central banks can also join the have your cake and eat it party. Rather, in the long run, monetary policy determines the nominal or money values of goods and services. That is, the general price level. An equivalent way of making the same point is to say that in the long run, monetary policy in essence determines the value of money. Movements in the general price level indicate how much the purchasing power of money has changed over time. Inflation, in this sense, is a monetary phenomenon. However, monetary policy changes do have an effect on real activity in the short to medium term. And though monetary policy is the dominant determinant of the price level in the long run, there are many other potential influences on price level movements at shorter horizons. There are several links in the chain of causation running from monetary policy changes to their ultimate effects on the economy. The practical impossibility of controlling the quantity of bank reserves and the need to set the short-term interest rate exogenously may have been recognized and reflected in the political layer. However, the fact that the new operational reality meant the removal of constraints which had previously prevented the state or central bank from controlling the whole spectrum of interest rates has not been recognized in the political layer. This term of social events provides useful insights into the relationship between the operational reality and the socio-political layer. Despite the realization of the need to set the overnight rate rather than the quantity of reserves, determination of longer-term rates was left to the market. That such an approach was a choice, not an operational necessity, as it once was not understood. Failure to grasp the nature of the new operational reality, firstly by economists and secondly in the socio-political layer, meant the retention of both the erroneous view that flexible market-driven long-term interest rates had the ability to coordinate saving and borrowing, and of the unwarranted fear of crowding out. Such a situation has had serious consequences for the conduct of both monetary and fiscal policy. The state could, and still could, use its position as monopoly issuer of the currency to control the whole spectrum of risk-free rates. Or to put it another way, it could determine the shape of the yield curve. All that would be required would be for the central bank to agree to buy unlimited quantities of government debt at prices consistent with their targeted interest rate for any maturity. This would result potentially in significant central bank balance sheet expansion. The mainstream view of money has had a critical role in this non-recognition. If money was viewed analytically, at least as a commodity rather as credit, loanable funds theory could make logical sense. Households would supply loanable funds to banks in increasing quantities in response to higher interest rates, as the opportunity cost of spending was rising. If demand for loanable funds rose, then higher interest rates would be required to induce households to supply them. The long-term interest rate must therefore be left to the market and allowed to rise in order to generate sufficient saving to meet demand from borrowers. Otherwise, there could be a chronic shortage of saving. Underlying this view is a metaphysical belief in the equilibrating powers of flexible long-term interest rates. If the long-term rate was set too low, then borrowing would be higher than its optimum level and would not be supported by saving. The result would be malinvestments, a credit boom, and inevitably a crash. The mainstream view of the nature of banking lent weight to this approach. Mainstream theory treats banks like funds. Funds take money from a source or sources and lend or give the money to others. Banking, however, is a fundamentally different process. Banks do not take deposits and then lend them out. Indeed, banks may make loans without the possession of prior deposits or reserves. Banks take a position in assets by granting credit to borrowers and at the same time accept liabilities upon themselves. The granting of a loan by a bank is fundamentally a balance sheet expansion exercise. A bank customer who is granted a loan gains a bank deposit, a liability to the bank, and at the same time the bank acquires an asset, the loan. Assuming the loan is spent and the receiver of the credit holds an account in a different bank, the lending bank will find that initially its balance sheet shrinks, that is, it loses the deposit and reserves. However, once the loan is repaid with interest, the reserves are replenished, with additional reserves equivalent to the interest on the asset side. On its liability side, the interest payment has boosted the bank's net worth. Provided the borrower repays the debt in full, the bank makes a profit on the transaction. It is clear from this mechanism that loans create deposits, not the other way around. Consistent with the erroneous mainstream view of money, banking, and interest rate determination is the crowding out hypothesis. Higher government borrowing would increase demand for loanable funds. Like any other commodity, its price or interest rate would rise. This higher interest rate would reduce private sector borrowing. Given the mainstream preference for private investment over public investment, such a situation should be avoided as a matter of urgency. In the current operational reality, borrowing by the state is not operationally required, and even if the state decided to borrow, there would not be any straightforward correlation between increased deficits and rising long-term rates. Under the gold standard, governments were constrained in their spending by their ability to tax and borrow. If a fiscal deficit existed, there would be untaxed spending in the system, which could be converted into gold at a fixed rate. In this case, the state would need to offer market-determined rates to induce holders to buy non-convertible government debt rather than convert into gold. The new operational reality is different. The government spends first and creates reserves ex nihilo. It is never revenue constrained, as a currency user might be. The borrowing operation, which removes the reserves, is voluntary in an operational sense. The state has no need to borrow. It could allow any untaxed spending to remain in the system. The problem with this is that such a policy would result in the overnight rate falling to zero if no other action was taken. See below for further elaboration of this point. Banks cannot reduce the aggregate level of reserves in the system. Excess reserves would mean that banks would try to lend them on the overnight interbank market, driving the interest to zero. In operational terms, sales of debt are not a borrowing activity, but are required to maintain a positive short-term interest rate. Mosler's view of the operational reality of the banking system might be considered as more radical than a standard post-Keynesian approach. For Mosler, loans simultaneously create both deposits and any required reserves as a point of logic and as a matter of accounting. It is never about the central bank accommodating reserve needs, as in the first instance, a need is an overdraft in the bank's central bank account. It is a loan, and is in fact booked as a loan from the central bank if the overdraft remains on settlement date. The only way the central bank could not accommodate would be to prevent the check or interbank transfer from occurring in the first place, which is beyond impractical and even moot in the case of deposit insurance, where the government guarantees clearing of client checks written against insured deposits. Furthermore, the central bank requires banks to have sufficient equity capital and sets asset and liquidity standards required of banks so that it can prudently allow daylight overdrafts of member bank clearing accounts in the normal course of business. Mosler emphasizes that this is a critical insight provided by MMT, and bemoans the fact that most all post-Keynesians today still cling to the narrative that the central bank must accommodate system-wide reserve needs to prevent disruption and or manage the interbank rate. He agrees that the central bank manages rates when it prices the overdraft, but adds the caveat that the overdraft in any case is created at the instant the loan deposit overdraft is created. For Mosler, this takes away the significance of the question, what would happen if the central bank doesn't accommodate? Something which monetarists insist they should not do when the money supply is too high, and post-Keynesians respond with, they must to maintain orderly clearing, or something else unsatisfying to monetarists and others. The failure to understand this key insight has the unhappy consequence of keeping the issue as an open question. In the pre-GFC era, many central banks implemented their monetary policy by setting interest rate targets and altering the supply of reserves in order to keep market rates in line with the policy rate. In most cases, this was done using a variant of the so-called corridor system. Following the GCF, there were widespread operational changes in the implementation of policy. This manifested itself in part by changes such as the introduction of floor system In the aftermath of the crisis, central banks used extraordinary measures to boost bank lending. There was an explosion of bank reserves. See Keister and McAndrews, 2009. And in order to prevent the overnight rate falling to zero, central banks were forced to offer an overnight rate of interest on reserve deposits equal to their target rate. A full discussion of the corridor system and its variants is beyond the scope of this paper. For a detailed analysis, see Mosler, 2012, page 47 to 57, The Bank of England, 2010, page 292 to 300, Lavoie, 2010, page 3 to 17. Mosler's approach differs methodologically from the standard corridor model. It might be considered as a pure system-wide model, and its fundamental insight comes from an analysis of the system as a whole. In contrast, the standard model, exemplified in the Bank of England paper, takes its starting point the expected behavior of individual profit-maximizing banks. From this perspective, it is possible to derive the expected shape of an individual bank's demand for reserves, and by implication, the demand curve for reserves as whole. Given the shape of the demand curve, the central bank can adjust the aggregate amount of reserves using open market operations so as to hit its target rate. The on-demand standing facilities, or discount window, and the deposit rate if present, giving a ceiling and floor to the overnight rate and limit the potential divergence of the overnight rate from the policy rate. We come now to the crux of the question. Mainstream theory maintains the illusion that self-imposed constraints are actually part of operational reality. Such a view has profoundly detrimental consequences for the conduct of policy. The mainstream perception of money underlies their approach. Money is treated as a true commodity, and the interest rate thus becomes the variable which coordinates the actions of savers and borrowers. Its mystical power to balance the two and generate equilibrium is lauded. However, this ontological view of money is at odds with Polanyi's contention that money is a fictitious commodity. As Innes has told us, money is credit and always credit. The quantity of money is an endogenous variable. Demand for loans creates the supply of loans, subject to satisfactory creditworthiness being perceived by creditors. There is no market for money in a neoclassical sense, and the interest rate has no magical powers, allowing it to generate equilibrium. The risk-free rate of any duration is always under the control of the issuer. The rate of interest charged by banks is merely this risk-free rate plus a risk premium. As discussed earlier, according to mainstream theory, increased government borrowing will raise the price of borrowing, the interest rate. However, this has not happened. Take the cases of Japan, the UK, and the US, where we have seen massive and growing government deficits, yet falling bond yields. Mainstream theory has produced some weird and wonderful explanations, or immunizing stratagems, for this which we won't discuss here. Perhaps deep down bond dealers know the truth, that a nation issuing its own currency can always control the long-term interest rate, and, when push comes to shove, it will ignore its neoliberal mainstream dogma and do just that. Quantitative easing being a case in point. The global financial crisis apparently has at least persuaded central banks to grudgingly accept a few heterodox ideas. The article Money Creation in the Modern Economy is notable in this regard. However, one swallow doesn't make a summer, and we are very long away from general central bank acceptance of the new ideas put forward by post-Keynesians in general and MMT in particular. In principle, the ideas grounded in monetarism, now often described as neoliberal, which support the use of floating exchange rates, should have allowed the introduction of approaches which freed up fiscal and monetary policy, allowing governments to pursue public purpose. Clearly, this hasn't happened. The legacy of fixed exchange rate regimes has remained firmly entrenched in the socio-political layer. Tight budgeting, no longer required to protect the exchange rate, is retained for entirely different, primarily ideological reasons. The metaphysical idea that governments are less efficient in using resources than the private sector. Deficit financing is still out of fashion, but no longer due to the influence of external constraints. The old theory of interest rate determination, loanable funds, is also a useful hanger-on from the past. It underpins the idea that if the government borrows from a fixed pot of saving, it will drive up interest rates and crowd out private sector investment. Mainstream thinkers consider that was formerly essential to mitigate the effects of membership of the gold standard or fixed exchange rate regimes as still being an essential part of operational reality. But this is patently not the case. Much of what was once useful is now defunct, and part of a large unnecessary baggage of self-imposed constraints which prevent democratic government from making full use of their much expanded policy space to pursue public purpose. The political pull of the self-regulating market is still very strong, possibly getting stronger as the political environment moves to the right. The mainstream view is no longer valid for countries issuing their own non-convertible currencies and only has meaning for those operating under fixed exchange rate regimes. The two monetary systems are very different. You cannot apply the economics of the gold standard or US dollar convertibility to the modern monetary system. Unfortunately, most commentators and professors and politicians continue to use the old logic when discussing the current policy options. It is a basic fallacy and prevents us from having a sensible discussion about what the government should be doing. All the fear-mongering about the size of the deficit and the size of the borrowings and the logic of borrowing in the first place are all based on the old paradigm. They are totally inapplicable to the fiat monetary system. Mitchell, 2009. The key issue to highlight here is the critical difference in the relationship between the core reality and its accompanying political layer under the gold standard and under a fiat system. Under the gold standard, the political layer contained the results of the double movement in practice, as society protected itself by the development of a protective belt. This included a huge array of reactions, such as labor laws and trade unions to mitigate the effect of a self-regulating market for labor. However, here we will focus on a consideration of the market for money. To recap, central banking may be viewed in this light as a spontaneous and necessary response to the operation of the international market for money. The current situation may be viewed differently with respect to money at least. Neoliberalism wields huge influence and effects on labor are strong. Many of the post-war gains have been wiped out. Trade union power has waned, and labor's ability to protect itself has been reduced. Nevertheless, the power of a self-regulating market continues to be impaired, albeit to a lesser extent. Without this counter-movement, labor's relative position vis-à-vis capitalist elites would be even worse. We might now consider the opportunity afforded by the new monetary reality, effectively modeled by MMT. A new socio-political reality is possible, which throws off the shackles of the old. The government can now act as a currency issuer and pursue public purpose. Functional finance is now the order of the day. For most nations issuing their own fiat currency under floating exchange rates, the situation is different to the days of fixed exchange rates. Since the gold window closed, a different core reality exists, one which potentially, at least, provides governments with significantly more scope to enact policies which benefit society. However, the political layer, in the way it interacts with monetary reality, has a detrimental effect on the power of democratic governments to pursue public purpose. In the new monetary reality, political arrangements that sprang up under the old regimes are no longer necessary or beneficial. They can largely be considered as self-imposed constraints on the system. In short, the political layer contains elements which are out of date, ideologically based, and unnecessary. However, mainstream economists have not grasped this situation, or perhaps they cannot allow themselves to, because of the vice-like grip that their ethics and traditional training has on them. Under the gold standard or fixed exchange rate regimes, it was necessary for a government to subjugate its budgetary policy to the needs of the international monetary system. If it wished to be part of the gold standard club, it had, in effect, to act like a currency user in its own currency. Nowadays, for most nations, a different monetary reality exists, one which allows governments freedom to act as currency issuers. However, given the hegemony of neoliberalism, governments operate under different rules, but still continue to act as if they were currency users. In practice, the political layer includes several outdated blockages. Notable examples include the imposition of debt ceilings, prohibition of direct sales of government debt to the central bank, and the need for government treasury departments to hold positive balances at their own central banks. An understanding of MMT allows us to see these rules as self-imposed constraints. They are no longer required to mitigate the effects of the self-regulating market, yet they are retained. For those who cannot recognize the new core reality and remain embedded in the old one, they remain essential or at least are stated as being so. However, in practice, they are often circumvented. When the political situation demands it, governments will exercise their power as currency issuers. The situation is complex, as politicians publicly endorse their critical importance but then carry out policies designed to circumvent their impact, only of course when it suits their political purposes. Their actions of course would never be described in those terms, and the impact of the voluntary constraints would never be sufficiently and consistently avoided so as to allow public purpose to be pursued. A case in point would be the so-called debt ceiling in the USA. Under conditions of the gold standard, a debt ceiling may have had some operational meaning, since an ever-increasing level of untaxed spending would increase the risk of conversion into gold and a loss of reserves. Higher and higher interest rates may, in principle, have been required to prevent a loss of gold. In a modern context, with no convertibility, the need for a debt ceiling has gone. The level of net spending by the government should be set at the level required to maintain full employment. Debt ceilings, however, have great appeal to libertarian groups, and therefore remain firmly entrenched within the socio-political layer. They represent, in essence, a limit on the government's willingness, not ability, to net spend. A second example concerns the rule that central banks cannot buy debt directly from the Treasury. Again, in principle, such a rule may have had some archaic operational value, but in the modern setting, it is merely an unnecessary self-imposed constraint, based on a profound misunderstanding of the true operation of the monetary system and ideological prejudice against government deficit spending. The original idea behind the rule was to prevent monetization of public debt. If the government borrowed from its own central bank, it would raise the money supply, and according to mainstream views, this would be inflationary. Therefore, debt would need to be sold to private sector holders of currency. In this case, provided the central bank did not accommodate the sale by increasing reserves, the money supply would not rise and there would be no inflationary consequences. However, excessive sale of debt to the private sector was frowned upon for different reasons. As mentioned above, given the existence of limited savings to borrow, increased demand from the public sector would drive up interest rates and crowd out private sector investment. However, in the pre-GFC days, when the Fed managed the level of reserves in the banking system in order to meet its federal funds rate target, monetization was impossible in practice. Once the Federal Reserve Board of Governors sets a Fed funds rate, the Fed's portfolio of government securities changes only because of the transactions that are required to support the funds rate. The Fed's lack of control over the quantity of reserves underscores the impossibility of debt monetization. The Fed is unable to monetize the federal debt by purchasing government securities at will, because to do so would cause the funds rate to fall to zero. If the Fed purchased securities directly from the Treasury and the Treasury then spent the money, its expenditures would be excess reserves in the banking system. The Fed would be forced to sell an equal amount of securities to support the Fed funds target rate. The Fed would only act as an intermediary. The Fed would be buying securities from the Treasury and selling them to the public. No monetization would occur. The irrelevance of the rule can be illustrated by the post-GFC use of quantitative easing. Given the insight that the government can only tax or borrow what it has already spent or lent, the true relationship between the government and the central bank becomes apparent. The government must first spend or lend before the central bank can drain the reserves it creates by the sale of bonds. So the government always spends by creating new money. The sale of bonds is a voluntary activity used to maintain the overnight interest rate. As we saw earlier, during the aftermath of the GFC, the extensive use of quantitative easing caused a huge rise in the levels of reserves. This would have caused the overnight rate to fall to zero had not central banks offered to pay a rate equal to their target rate on excess reserves. If monetarist ideas had any traction, economies should have seen an explosion of monetary growth and inflation. Neither happened. The effect of quantitative easing is really the same as a direct sale of debt to the central bank. First, the government spends, then the central bank sells debt to soak up reserves. Quantitative easing just means buying them back. Functionally, it is the same thing as selling the debt to the central bank in the first place. To reiterate an earlier point, in any case, there is no operational need to sell debt to either the private sector or the central bank. The Treasury can deficit spend and leave the excess reserves in the system. If the central bank wishes to pursue a positive interest rate policy, it would merely offer a positive interest rate equal to its target rate on excess reserves held in the banking system, if deposited at the central bank. Alternatively, it could allow the rate to fall to zero, ZIRP. Under fixed exchange rates, the no direct sales of government debt to the central bank rule may have had an operational purpose. This no longer exists. Another self-imposed constraint is the requirement for treasuries to hold a positive balance at their own central bank before spending. For example, in the UK and USA, meeting this requirement requires a particular sequence of transactions involving the central bank and the Treasury. This is because in order to obtain the necessary positive balance, the Treasury must acquire non-government funds which it had already created itself by its own deficit spending. These non-government funds will more often than not be in the form of previously issued securities, necessitating a repo transaction be carried out by the central bank. In the case of the U.S., the Fed would carry out a repo, buying securities from the relevant private sector financial institutions. This provides the necessary reserves for the private sector to buy the new issue of debt, which is required by the Treasury to replenish its balance at the Fed. When the reverse repo transaction is carried out, the private sector now holds more government securities than previously, and the Treasury has a positive balance as required. A full explanation is provided by Ray, 2012, pages 105 to 109. Since existing Treasury securities were issued as a result of previous government deficit, It is the case that the reserve balances required to purchase Treasury securities are the result of a previous government deficit or a loan from the Fed to the non-government sector. This is true even though the Treasury must have a positive balance in its account before it can spend, and even though the Fed is legally prohibited from providing the Treasury with overdrafts in its account. Thus, we have a self-imposed constraint par excellence, requiring financial legerdemain, but in practice have no operational significance. We might ask why the voluntary, out-of-date constraints are retained and certainly considered as vital long-term elements of the system, although, as stated above, they are often nullified in the short term for the purposes of expediency. It may be that most, if not all, leading politicians and their economic advisors do not understand monetary operations. If this is true, it would be a worry. They may be stuck in fixed exchange rate logic when the old rules applied. Alternatively, they may understand the system but choose to operate as a currency user in order to apply strict budgetary practice to encourage efficiency. They may be so deeply attached to the idea of the primacy and hegemony of markets that they may be unaware that the power held by private markets has been ceded to them by states as a matter of deliberate policy. They may believe that the historic growth of market power to be a natural and positive development. This means they are naturally constrained in their actions. For example, a government may be concerned about the effect of a change in macroeconomic policy on interest rates, even though it possesses the intrinsic power to control the whole spectrum of rates. The situation regarding the exchange rate is more complex, as a nation-state cannot know for sure the effect of a given economic strategy on the exchange rate. However, it is far from certain that adopting a full employment strategy would generate a catastrophic fall in the exchange rate, as pessimistic neoliberals suggest. If the worst came to worst, exchange rate controls could be used to control the rate, a small price to pay for full employment.